Europe is at the brink. Its economy faces a long recession, its people are restive, and the order that has brought peace to a once war-torn continent may yet come apart. In just 2 years, a government debt crisis that began here in Greece has infected all of Europe, and maybe soon the world.
The European economic crisis continues. More and more people there are leaving to seek a better life in the world's emerging economies. And the Philippines is one of the top destinations to do just that. A boost of confidence in the Philippines has a lot to do with an improved
What is the Eurozone crisis? Well, when a group of interconnected countries have trouble repaying their government debts, things start to get complicated. As the old saying goes, to fill one hole, you must dig another. But who has the most dirt on their hands? Almost all countries in the Eurozone are involved. However, a few have made a serious impact. Ireland. Ireland kicked things off in 2008, but unlike the other players, this was not from government overspending. Ireland's property bubble burst in 2007, which caused the economy to collapse, leaving Irish banks out of pocket €100 billion. By April 2011, despite receiving a €67.5 billion bailout, the bank's debt was downgraded to junk status. As of 2013, Ireland's debt is looking to peak at 120% of their gross domestic product. Spain. Before the Eurozone crisis, Spain had low debt levels compared to other advanced economies. However, Spain spent large sums of money on bailouts after the property bubble unexpectedly burst. Amongst the economic downturn in 2011, the government began austerity measures in an effort to grab the bull by the horns. However, the public demanded a revolution, resulting in riots and protests. By June 2012, it became clear that Spain would need further financial support. Spain's debt to GDP is expected to hit 90% in 2013. Greece. Prior to the GFC, Greece's economy was one of the fastest growing in the Eurozone. However, after the collapse, Greece's tourism industry started sinking and the party was over. Greece received a rescue package of €110 billion in 2010, then a further €130 billion in 2012. What followed was a long period of political and civil unrest. Some experts believe that the best option for Greece would be to withdraw from the Eurozone entirely. Greece's debt level has since been reduced from approximately €350 billion to €240 billion. However, the debt to GDP is still expected to hit 170% during 2013. Cyprus. The Republic of Cyprus recently hit the headlines with its own set of economic complications. Cyprus has a large offshore banking industry that was devastated by the financial turmoil that was occurring in Greece. In June 2012, the Cypriot government was forced to request a bailout to support its banking sector. Austerity measures were put in place, and citizens' bank accounts were even raided in a desperate attempt to minimise further debt. Despite having previously been considered a small and stable economy, Cypriot debt to GDP has rapidly climbed from 49% to 93% in only a few short years. Overall, these are some of the most relevant examples of the domino effect that has been knocking the Eurozone's economy down. The Eurozone owes money, a lot of money, 10.84 trillion and climbing to be precise. So where are things heading? Well, in an ambitious plan to turn the Eurozone into a closer fiscal union, Brussels has been given the authority to serve as finance minister for the 17 countries. They will be overseeing national budgets and imposing harsh economic reforms to struggling countries. Whilst this is potentially positive news, many still believe that the turbulent times are far from over. What do you think? Is there light at the end of the tunnel?
The so-called original sin of European monetary union was that they created a system where you have monetary union without fiscal union.
The structure of the euro was such that you had to take fiscal discipline by the governments on faith, because the European Union does not touch the fiscal sovereignty of government. So you would have a group of countries with widely diverging economic growth potential and, frankly, fiscal positions with one interest rate, one currency. The problem that started in Greece quickly spread. This is because of the market psychology. They immediately look for countries who have similar characteristics to the one in trouble because they want to protect themselves against future trouble. So in the case of the European Union, that meant that Spain and Portugal, two peripheral countries with very similar characteristics to Greece in terms of lax fiscal discipline and welfare state and benefits, were immediately targeted by investors. Again, it was a very, very familiar pattern.
Trabahuhan ko, pareho pa rin naman yung benefits at salary namin. Pero hindi ko masabi yung sa iba. Actually, marami naging unemployed simula nung nagkaroon ng economic crisis. At marami din nagsara mga companies, lalo na yung mga Italian. Karamihan kasi sa kanila lumipat sa Asian countries kagaya ng China. Doon na sila nag-transfer. Ay, malaki yung itinaas ng cost of living. Nagmahal lahat pagkain, rento sa bahay. Pero pinakamataas ngayon yung transportation kasi doon talaga kumikita yung gobyerno. At sa sitwasyon nga ngayon, kailangan talaga ng gobyerno ng pera. Kung dati mahirap na mamuhay dito kasi nga malayo pa sa anak mo, sa Pilipinas. Ngayon, medyo mas sumirap. Pero kinakaya naman namin. Hindi ko pa naman naiisip na lumipat na ibang bansa para magtrabaho. At masasabi ko rin yan para sa mga ibang Pilipino dito.
European Union Ambassador Guy Ledoux says he looks forward to a free trade agreement between the Philippines and the EU, which could help boost trade and investment between the two countries. Ledoux adds the Philippines, which exports mostly electronic products to the EU, should also look at diversifying its product line.
Trade in 2012 between the EU and the Philippines has not seen an expansion, but has not been reduced. So that is already a good thing. But I think the Philippines needs to diversify its product. The EU has proposed to negotiate a free trade agreement with the Philippines. The door is open also for the Philippines. So we understand that currently the Department of Trade and Industry is having consultation with stakeholders. My guess it would be a tenfold expansion in terms of what the EU would invest in case the conditions were better. Clearly the Philippines is attracting a lot of attention in Europe these days.
Asian degree of integrations will increase for a couple of reasons. Number one is that the current global economic situation is in such that global demand for Asian products will be declining, will continue to decline, and that itself is already a force for Asia to integrate, meaning they trade among each other. But even in the area of financial sector, we also predict that the degree of integrations will increase in the region. Now, on top of that, policymakers in the region shows very strong intention to increase their cooperations and integration. So that itself is already a force for greater integration in the coming years, despite what happened in Europe.
The Banco Central sees no need to raise interest rates for now, saying inflation remains under control. Lois Calderon reports.
The Banco Central suggested it will keep interest rates steady again at next week's meeting, which could help support the markets and the economy, even as a series of institutions cut Asian growth forecasts. BSP Governor Amando Tetanco says inflation, the main factor in setting policy rates, remains in check. It's partly because an inflation driver, capital flows, exit emerging markets amid worries over U.S. Fed policy.
There's no urgency for a change in policy coming from that end. because inflation continues to be well under control. The gyrations in financial markets, like in the foreign exchange market, in the equity market, and the bond market, were short-lived. And we have seen lately more normal movements in these markets. You saw adjustments in all asset prices in the financial markets, prices in the financial markets, FX, equities, bonds.
So that's good.
To the extent that it reduces the risk of bubbles developing, or stretch valuations.